Hello everyone. My name is Revi Damayanti from Class AK23A, student number 234120007. Today, I would like to explain about investment in equity instruments. The material. First is Introduction to Equity Investment. Investment in equity instruments refers to the placement of funds by individuals or institutions in order to obtain ownership in a company. The main goal of this investment is to generate long-term profits, primarily through the appreciation of stock value and the distribution of the company's profits in the form of dividends. Unlike fixed income instruments such as bonds or deposits, equity investments are inherently volatile. This volatility brings the potential for higher returns, but it also increases the level of risk associated with such investments. Next, types of equity instruments. There are several types of equity instruments that investors may consider. Common stock represents standard ownership in a company, typically accompanied by voting rights and the possibility of receiving dividends. Preferred shares, on the other hand, often offer fixed dividends and priority in dividend payments and liquidation rights but usually lack voting power. Investors may also distinguish between stocks traded on public exchanges and privately held shares. Additionally, equity investments can be categorized as domestic stocks, issued by companies within the investor's own country, or foreign stocks, issued by companies abroad. Next, mechanism of equity investment. Equity investments are typically conducted through stock exchanges with the assistance of securities companies, which act as intermediaries or brokers. The process starts by opening a securities account, followed by selecting desired stocks, and then executing buy and sell transactions through a trading system provided by the stock exchange. Once the transaction is completed, the purchased shares are stored electronically by a custodian institution. The final step involves settlement, which is managed by a clearing and guarantee institution, ensuring the security and smooth functioning of capital market operations. Next, returns from equity investment. Equity investments can yield returns in multiple ways. Capital gains occur when investors sell stocks at a price higher than their purchase price, while capital losses are realized if the sale price is lower. In addition to price appreciation, investors may receive dividends, either in the form of cash or additional shares, distributed by companies from their profits. The total return from equity investment consists of the combination of capital gains and dividends received. The return potential is closely linked to the level of risk. Generally, higher risk is associated with higher potential return. Next, risks in equity investment. Investing in equity instruments involves exposure to various types of risks. Market risk is the risk of price fluctuation due to economic conditions and investor sentiment. Corporate risk refers to the possibility of a company's performance deteriorating because of internal issues such as poor management or operational inefficiencies. Liquidity risk arises when shares are difficult to sell or convert into cash quickly without significant loss in value. Moreover, investors must also consider systemic risks, which are broad economic or financial market conditions, and non-systemic risks, which are specific to individual companies. Next, investment strategies in equities. There are various strategies that investors may adopt depending on their financial goals and risk tolerance. Short-term strategies aim to capitalize on market fluctuations within a brief period, while long-term strategies focus on gradual growth over time. Growth investing targets companies with high potential for expansion and earnings increase. In contrast, value investing seeks undervalued stocks that are believed to be trading below their true worth. Regardless of the strategy, portfolio diversification is essential to reduce risk by spreading investments across different assets or sectors. That's the end of my presentation. Thank you for your attention.